I think they should have cut rates once or twice last year because, given the big, beautiful bill and the amount of spending and the amount of borrowing that we're going to see, even if the Fed tries to push down the target for Fed funds, which they should have done already, what's going to happen in the long end, Julia? I think we're going to see long-term rates stay where they are, which is going to be a shock to people.
Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst, investment banker, the very best independent analyst out there that you'll find on Wall Street, and author of multiple books and the second edition of Inflated: Money, Debt, and the American Dream, and certainly a friend of this show. It is so great to see you again, Chris. Thank you for taking the time to come on again. Really appreciate it. We love having you on every month.
Thank you, Julia. It's always a pleasure.
Always a pleasure. And I always say, there's so much to talk about. But yeah, this was quite the weekend. There's a lot of news and
yes,
so many places we should start, perhaps with like the one big, beautiful bill. But maybe before we even start to dive into the particulars, can we just get the latest update on you, more of the big picture, if you will? Can you go ahead and just set the table and then we'll dive right in?
Well, I think the Fed, led by Chairman Powell, is clearly late. And I say that because, I follow the banks both on the consumer side and the commercial side. Consumer is pretty quiet. There's not much going on. The commercial side, on the other hand, is a nightmare. It is just horrible in terms of both the losses that investors are taking. You see private equity and private credit investors now having to sell their investments back to the sponsors at deep discounts. And what was really fascinating over the weekend was a great piece by Josh Franklin at the Financial Times talking about how the Fed had ignored private equity in the stress tests. And I don't know how you do that. I mean, it's a complete train wreck. And yet they gave everybody a pass. So this helped Goldman very much. Goldman's been one of the best performing banks in our index, of course. So, it's a strange time because on the one hand, we have the Trump administration, the pro-business rules, that's great, but they keep doing certain things that are a little bit concerning. I don't see the Fed cutting interest rates anytime soon. And with the big, beautiful bill that you referred to, we're going to be running hot policy, almost like under Joe Biden in terms of fiscal deficits, except it's going to have a conservative focus instead of a progressive focus. So I don't know how you make sense out of this. We don't need rate cuts given the amount of deficits we're going to see.
Yeah. Okay. There are a lot of areas I would love to explore further with you. Let me think. Where do I want to start here? You mentioned that the Fed is late. Jerome Powell is late, and you don't see rate cuts anytime soon. So when I read into that, I'm like, okay, he's late. He's going to continue to be late. So what are the implications? What is the risk that we could see from him being late here?
Well, see, when I say he's late, what I'm saying is that in terms of credit, and especially in the commercial real estate sector, private equity, private credit, there are bad things happening. And if we don't get financing costs down soon, you're going to see a lot more defaults and a lot more losses. The banks are hiding all of this ugliness right now. We have more forbearance today than I've seen in a long, long time, going back to 2008. So that gives you some context. Don't believe the numbers that you're looking at, Julia. On the other hand, the consumer, the jobs numbers, all the stuff that the street focuses on rather obsessively, don't look bad. So it's almost hard to come up with a rationale based on the old model of a consumer-led recession, right? For aggressive rate cuts. I think they should have cut rates once or twice last year because, given the big, beautiful bill and the amount of spending and the amount of borrowing that we're going to see, even if the Fed tries to push down the target for Fed funds, which they should have done already, what's going to happen in the long end, Julia? I think we're going to see long-term rates stay where they are, which is going to be a shock to people. So I think it's different from a couple of years ago when we still had a lot of liquidity left over from COVID flowing through the system. It's almost as though the Trump administration wants to put that back. So they could win the midterm elections, because everything here is political, remember. There's not a lot of economic thought going on in Washington today. You had Peter Navarro on the wire this morning saying that they should just drop interest rates and see what happens. So, what I'm trying to say to you is I think the Trump people want to push things harder, get growth up, at least nominal growth. But I think the cost is going to be higher inflation and maybe higher long-term interest rates.
Okay, so that's interesting. So sounds to me like the road here, it's leading to inflation, as you put it. Talk to me about, you mentioned like the long rates remaining where they are, or I imagine possibly even going further, the shock to the system. Can you just put some more meat on the bones for that scenario?
Well, if you talk to most real estate people today, volumes in the first quarter were horrible. They're down 20, 25% year over year. So you hear a lot of screaming right now. People want to see interest rates come down from sevens for residential mortgages today down into the low sixes, high fives. That would at least give everybody some breathing room. They would like to see Fed funds lower because that's where people pay when they're producing new assets. That's where you store stuff before you issue a bond, right? So the cost of funding today is still, high fours, low fives, depending on who you are, could be much higher. So that's throttling new issuance in the bond market. On the other hand, though, if you look at some of the statistical indicators, and this is what the Fed has been talking about for months now, there's not a great argument to be made that we need lower rates like right now. There's no emergency. And again, the jobs numbers, other indicators are all over the place. You can pick the one that suits your narrative, right? So I think that overall, we're kind of being head faked by the fact that we don't have a consumer recession, but the destruction going on in the background in private credit and commercial real estates is quite considerable. The lenders have been consolidating this year. We've had a couple of big mergers. You're probably going to see more of that soon because they're out of money. You can only survive so long paying 103 for a loan and selling it at 101, right? You were in the business.
Yeah, you do bring up an interesting point because you point out like there's no consumer recession in sight. I'm looking on the prediction markets. Kalshi has a 20% chance of a recession. So pretty much no one's expecting one. But as you point out, it's the commercial side. And I think you and I have talked about in the past, that's what you would characterize as the silent recession, if you will. I mean, a lot of people are going to feel it, but it doesn't get the same attention, I guess.
No, there's no political constituency for real estate developers. They're not very popular. And you see the situation we have in New York City with this madman Mamdani who wants to freeze rent. You can't legislate economic outcomes. You can't get rid of inflation by passing a law or doing something ridiculous like that. But that's the politics in Washington. If you go up to Albany, this is how people think. So we're in a kind of a surreal time, I think, Julia, where many of the blue states have governments that are in shock still from the election of Donald Trump. And they're trying to fashion some sort of a narrative for their own political agenda that gets some traction with the voters. So you have, people standing up saying, well, we're going to freeze rent. Well, landlords are going to go out of business. And then New York City is going to end up owning those apartments. That's not good. In New York City, I wrote about this. The average person who's getting public housing doesn't even cover half of the cost. So the city has to subsidize that. And they do a really bad job. I mean, they don't have the money to take care of these assets. 500,000 plus public housing assets in New York City. So imagine if they have to start buying more. And these are old buildings, right? These are not new buildings. These are old antiques, in many cases over 100 years old, that really need to go. We should redevelop half of New York, to be honest with you. If we had real people who understand the problems and the need, we'd be knocking down large swaths of Manhattan and redeveloping it.
Yeah. Chris, I had multiple people ask me to ask you about the New York City mayoral race. Again, the prediction markets say 70% chance that Mamdani will win. Eric Adams at 27%. We like to look at the prediction markets here using Kalshi on the show. What do you think? Okay, one, I'd love to hear your thoughts on the race, but what do you think happens?
Well, if that occurs, the value of rent-stabilized and rent-controlled real estate in New York City is going to plummet. It's going to be unfinanceable. You've already seen Blackstone and some of the others that bought assets from signature banks selling them most recently. Everybody who's got exposures like that, Flagstar, the old New York Community Bank, the other local banks in New York City, they're all going to take losses, in some case catastrophic losses, because these assets will suddenly have no value. That's what Mr. Mamdani is going to do. Now, since Andrew Cuomo did not drop out of the race like he should have, the mayor is not viable. So I think Mamdani wins in a three-man race with other lunatics involved as well. I think he takes the 50% he needs. He could be a plurality mayor, though. He may get less than 50. And I believe that was the case with de Blasio, too. Only the crazy unions came out to support de Blasio.
I feel like people probably like de Blasio. People probably like de Blasio compared.
At least he looked the part, even though he was very much of a Marxist-Leninist, thanks to his wife. But this guy, I think, will be a disaster for the city. The city has been kind of recovering in multifamily. But the reality is that inflation has made a city that was already unaffordable even worse. We should be relocating people out of New York City. There is no justification to keep low-income families in that city. They just can't make it. Because there's a minimum cost to renting an apartment in New York. Mm-hmm. You get a little bit more in the boroughs than you do in Manhattan. But, the public housing, like I said, is half of the cost. Figure the cost is about $3,000 a month per unit just to operate it.
Yeah. Well, okay. So in the event, he's probably going to win. Do you think we'll see an exodus of like the wealthy New Yorkers? Like you kind of hear that chatter that the wealthy, what do you think happens there?
No, it's not that so much. People with money are indifferent to people like Mamdani. They live in condominiums. They don't go into rental housing that he's going to care about. But it is going to hurt consumers because the landlords who own these buildings, if he freezes rents and he makes it impossible to renovate old units as they come up for rent after a long-term tenancy, then they'll just lock them. They'll gut the apartment and they'll lock it. They won't show it for rent. And what that's going to do is reduce the housing stock, and you'll see these assets get knocked down over time, turned into condominiums and co-ops, mostly condos. So the rental stock will dwindle. And I don't think we have any interest in that. That's not going to help people, Julia. But unfortunately, local politicians, and this goes across the country, right? I don't care what city you're talking about, can't control inflation. That's a Washington issue. And unfortunately, it's spilling into politics. It's radicalized the Democratic Party. You can't be a moderate in the Democratic Party today. There's just no way to do it. So Mamdani is kind of mainstream in New York. AOC is conservative compared to him.
That's crazy. Wait, do you think this is the product of inflation then?
Oh, totally. Inflation ripples through our entire society. So when you have bad fiscal policy in Washington, two parties that are completely useless when it comes to governing the country, people look for change. This is why Elon Musk wanted to start a new party. I think he should stop wasting his time. But, I asked something on Twitter this morning. I had a long conversation with Dan Proft on AM 560 in Chicago this morning. And he said, Chris, you're talking to me about March 1933. And it's because until you have a crisis in this country, people aren't going to do the right thing. They're just going to pursue their short-term interests. In Argentina, things got so bad that they actually elected this wonderful madman named Milei. And they said, here, fix it. Even though he doesn't control the Congress. But things got so bad that they said, here, go fix this. So unfortunately, the U.S. is a long way from that. And I think you're going to see much higher inflation as a result of the big, beautiful bill.
Yeah, we should talk about that because I did see your tweet as it relates to the short-term benefits of the one big, beautiful bill's cuts, the long-term threats of deficit and inflation. So you ask, when does America have that Milei moment? Do you think that's what we're headed toward then?
Oh, yeah. When you get inflation up to double digits, the politics in this country are going to become completely disrupted. This is what a lot of I mean, some of the conservatives in the House, I think, understand this, but they got rolled by Trump. Remember, they wanted to stand their ground and demand more cuts. Nope. Everybody caved in. And it's almost a case that politically, given Trump, no one can even argue about budget deficits anymore. They're just going to spend money and see how it goes, like Peter Navarro was saying. I think that's dangerous. You can play games in politics in Washington, but when you play games with the markets, sometimes things can go differently than you expect.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Yeah, I'm looking at the debt clock right now. It's north of 37 trillion. The prediction markets on Kalshi are forecasting that we'll hit 40 trillion. How high will the national debt be this year? 40 trillion is the forecast at the moment on the prediction markets.
Yeah, that sounds about right.
Yeah. I want to reference something you wrote in a note over the weekend. So I'll read you. You can raise the debt ceiling in Washington, but somebody must sell Treasury debt to an investor. This is one reason that Secretary Bessent has suddenly stopped talking about issuing more long bonds. Now, apparently he wants to follow his predecessor, Janet Yellen, in issuing T-bills to finance the federal debt. Issuing mostly T-bills to finance new and existing debt is the last resort before the U.S. will be forced into a default or outright restructuring. But of course, nobody is talking about that this week in Washington. So it sounds to me like this strategy, it's going to be teed up to backfire.
Well, I agree with your characterization, Julia. When I did a lot of work in Latin America years ago, particularly in Mexico, and Mexico used to have to keep their T-bills, they were cosetes, with a very high interest rate. In other words, you started with very high short-term rates and then they went down over time. So you had an inverted yield curve, the opposite of what we have today. And essentially, Mexico and other nations had to keep that short-term rate high to support their currency versus the dollar. That was the penalty that you had to pay for having bad fiscal policy, bad monetary policy. And they had high inflation. So look at Argentina, and all of a sudden you've gone from that situation where they were totally defensive, high rates, they didn't even have a free exchange rate in the currency. Now all of that's gone. And he's been able to reorient the economy back to the marketplace. The U.S. has a largely government-controlled market today. 25 years ago, the Fed nationalized the market for Fed funds. It's now a policy instrument. And in 2008, most of the primary dealers in the United States got annihilated. The ones that lasted got bought by banks, right? So that non-bank market that had served as the place where we sell bonds, all of a sudden was gone. And we're almost back to where we were in the 50s, 1950s, by the way, which is when banks were the big buyers of government debt. You didn't have a large marketplace. You didn't have that many even individual investors buying government debt at the time. It was very small. So the Fed and the big banks had financed the New Deal and World War II all by themselves. So unfortunately, we're kind of headed back in that direction. And I think they're going to have to force T-bill rates down to keep the deficit from growing too fast. And they will in turn force banks to buy them. But imagine this, Julia. Imagine if T-bill rates are below the cost of funds. Imagine if the banks have to take a loss to own T-bills.
And you'll have to force them to buy. Okay.
That's called financial repression. And, certain institutions have to own risk-free assets. So when Secretary Bessent says, well, I'm not going to issue more 10s or 30s, I'm just going to issue T-bills, what he's essentially doing is putting all of that pressure on the short end of the curve. And the question is, can they keep it down, especially if they don't have a good relationship with the Fed? Everybody's waiting for Chairman Powell to end his term next year. He may stay on the board until 28, just to spite Donald Trump. So, this game is not nearly over. And I'm a little worried that the cast of characters we have in the White House today don't know how to play this game. I've known Fed chairmen since Arthur Burns, and this crowd is not managing their relationship with Jay Powell very well.
How does one play the game, if you will? Or should they
you
play
let
the game?
Man finish his term without berating him in public, and you put a reasonable candidate up to take his place next year. You manage it in a civil and reasonable way that enhances confidence instead of takes it away.
Mm-hmm. Yeah, I imagine you kind of can't take back the name calling at this point. So a little hard to do that.
Look, all Fed governors want to protect the temple. This is the great temple of Jerusalem, right? So once they become officers of the United States and they're sitting at the big table, they will defend the institution. They don't want Donald Trump to take over the Fed. They don't want to see him push interest rates down to 1%. I think you'd cause a financial crisis in this country if you did that, especially if you do it the wrong way, in a glib and childish way that makes people think that you're not competent.
We did talk about banks at the top of the show. And look, you are known as an analyst in this space, and that is one of the lenses in which you look at the world and how you understand what's happening in the economy, in the markets. Can you give us more of a dive into what's happening in the sector? What are you seeing? What's on your radar? Anything that's even concerning to you? I'd love to hear.
The big concern we already alluded to, credit is pretty quiet on the consumer side. It's ugly on the commercial side. But the real issue for me is that we see a lack of demand for credit. And what this is showing, it appears very clearly, the yield that banks are getting on loans is falling because they're all competing for the same piece of business. And so they're having to be concessional on their pricing. On the other hand, they don't need deposits. So deposit yields are falling too. The banks are saying, no, I don't have to roll less CD. And they push their rate down. So what that shows you is there's deflation in the system, Julia. And I think that is a concern. That's a price. In a way, President Trump is right. Powell should have dropped rates last year, in the third quarter last year, and they didn't do it. So now they're late. And I worry that we could see yields on loans falling and volumes are falling too. That's a classic deflationary scenario.
What would that mean for the economy then if you're seeing that play out?
You'll see default activity rise, and you'll see it in consumers too. You see a little bit of this in the bottom quartile of consumers in terms of income, but the 3/4 on top, no. Defaults are very low. If you look at all the consumer lenders, we did a piece on them last week, their default rates are going sideways, and they've been like that for 8 quarters. There's really very little activity.
You mentioned also at the top, private equity is a train wreck, and the Fed ignored what's happening in private equity. Could you put some more meat on the bones there? That also piqued my interest, and I would love for you to unpack the specific risks that you see in that sector today and what that could mean.
Banks have direct exposure to private equity. Sometimes they will own a fair amount of it. They're also sponsors of private equity transactions, along with non-banks who are involved in that. They lend against these assets. So what's happened is both the banks and the non-banks are slowly buying back a lot of deals that didn't work and where the valuations have fallen dramatically. When I say dramatically, I mean 50 cents on the dollar, Julia. So investors are being forced to sell this stuff. You saw maybe the headlines about Yale University. Yale had been one of the biggest, earliest proponents of private equity investing as a way to diversify their foundation investments. And it's turned out to be horrible. You could have done better just buying the S&P 500 futures. And at least you'd have liquidity. So what we're seeing is that the promise of private equity has not turned out. There is direct exposure for the banks if they own this stuff themselves, And then they have customers who can turn around and sue them because of the representations that they made when they put them into these strategies in the first place. BlackRock, for example, has a fund that they set up just to buy the bits and pieces of these deals at a discount. So that tells you something.
Interesting. Another topic I'd love to bring up with you is the US dollar and the decline that we've seen in the dollar 10% this year. What do you make of what's happening with the dollar? What is that signaling? Is there something we can read into it?
Well, we've written a lot about how we see this monetary reserve status of the dollar evolving over time. I think it's pretty clear that gold is returning to the primacy it had in the past in terms of reserve assets for most central banks. They're buying it based on volume. They're pretty much indifferent to price. I think the U.S. should be doing the same thing too, by the way. We talk about that in the end of my book. There's no reason not to be selling paper and buying gold right now if you've got your head screwed on. So, what that means to me is that the dollar is going to decline in relative terms versus other currencies. You won't see the euro or the yen grow very much, but, eventually the Chinese and the Russians are going to have to let their currencies expand if they want to create an alternative to the dollar. And I think, like I say, gold is slowly migrating back to being the chief reserve assets for global central banks. And I tell my readers, I think they should all have gold in their portfolio. I've got 25% of one of my portfolios in gold, and I'm just going to leave it there.
Mm-hmm. Do you do the physical gold, or do you do like the ETFs, or is there any way you like to own it?
I'm using the ETFs right now. Physical is expensive. You've got to be a substantial investor. Although I will tell you that the model in Asia, which is increasingly the price setter in gold, is for kilo bars, which are relatively easy to transport. They're not doing the old good delivery bars where you had to put on the steel shoes when I worked at the Fed of New York. So, you didn't drop it on your foot.
Oh my gosh.
Yeah, no, but those bars, they don't go anywhere. They may go from one cage to another, but they basically stay in the vault at the Fed or in a private repository. I have friends who are building a repository in the Bahamas right now because they see increasing demand for physical gold. And again, that might just be
why
kilo
the Bahamas?
bars.
Curious. Yeah, why the Bahamas? And
it's 60 miles from Florida, U.S. law. It's very secure. It's got a good government. Does not have some of the unfortunate connotations that we've seen with other island venues. So, I think it's a good choice.
Interesting. Yeah. Okay. So that will be music to a bunch of people's ears who watch this channel, because I feel like a lot of folks who watch, they do like gold. We're not a gold channel, but people do like gold.
I was just talking to Dr. Paul the other day. We had a great conversation about gold.
Okay. Honestly, dream guest would be Dr. Ron Paul. Just saying, dream guest. So you mentioned, I'd love to hear about that conversation at some point. Whatever you could tell us. But gold, what else? Talk to me about how you want to be positioned in this environment.
Well, I have short-term treasuries and bank preferreds. The banks are buying back a lot of their preferred securities. So that is not going to be as available to investors as it has in the past. When they lower the capital rules in Washington, you don't need all of this extra tier 2 equity. So it's very interesting what's happening there. I am working with some non-banks that want to start issuing preferreds in the mortgage sector. But I think there's going to be a lot of demand for income. So I tend to keep about half of my book relatively short in income generating securities. And then I've got a bunch of equities. I own American Express. I bought it after the Independence Day market sell-off. When it got cheap, it had a 5 handle on it instead of a 7 times book. So, and I've been looking at some of the other commons because the banks have been outperforming just about everything else this year. The managers started running back into them, May timeframe, and they took off. So it's not like the fundamentals necessarily justify that, but I like to trade. I own Annaly, still throwing off a 15% coupon for, leverage investment in government insured securities. So that works. But that's really, I have my position in gold. I've been short dollars at times, but I squared that one off 3 weeks ago. I'm long the S&Ps just because they've been going up, right? We're setting new records in equities while we're getting ready to set records in the fiscal deficit as well. But I think it just proves the point. The equities are an inflation hedge. And when you see them going up this way, that's what they're telling you.
Okay, an inflation hedge. It's also interesting. It sounds to me like it's probably really important to be nimble too, because you mentioned like trading.
You have to discipline yourself, and if you're going to do some of the short-term trading that I do, you have to watch it. You've got to be staring at it all day long, and you've got to set your sell orders underneath your positions. I go on and on about this with my readers. If you're getting handed double-digit gains because of inflation and momentum, put your sell orders underneath the positions, and you got to adjust them as you go.
Let me ask you this, because we didn't bring this up in this conversation yet, but housing, I think you probably mentioned it, but can you talk to me about your viewpoint on housing today? We've had a number of guests who've talked about housing recently, but just would love to get your take.
Well, housing, the volume numbers in the first quarter were pretty awful. They were down 20-25% year over year. And that's just because of affordability. The markets are compressing above that average size of about $450,000 in certain areas of the country. If you look at the regional Case-Shiller indexes, which are an average, remember, they're going down. On the other hand, the bottom of the stack, where there's very little supply, no. Here in New York, blue state, where we don't have a lot of construction, no. You still have very, very strong demand for homes because there's not much supply and there's very little available, just in terms of existing homes. So to me, the lock-in effect is still a big deal in housing, Julia, simply because of the 30 or 40% of people out there who have low mortgages. I've got a 3. So it subsidizes us living in New York compared to a 7. It's pretty simple math. I think one of the reasons that President Trump has been so vocal about the Fed and interest rates is housing, but not just residential. I'm sure he's hearing from all the realtors and everybody else, right? Volumes are low. Everybody's starving to death. But the commercial side is just, as I said before, a train wreck. If we can't refinance some of these assets at lower rates, then they're going to be restructured. And in fact, I think restructuring is a given in many of these cases.
Yeah. Yeah. Huh. It's interesting. I always like asking my guests about it because it's something we like to watch.
In terms of credit, 1 to 4s are still pristine because of home prices. If home prices start falling, then the cost of credit will become visible. But, when you have somebody who gets in trouble who's like 3 months behind on their mortgage, you're the servicer, right? You're talking to them on the phone. The first thing you're going to say to them is say, look, let's sell the house. I'll pay off the loan and you get the net. And that's how they help these people. If home prices weaken, then that tool is going to suddenly disappear because then the cost of default will become real again.
Well, my thought is like, who's buying right now? Like the neighborhood I like to exercise in, I counted, I'm not exaggerating when I say this, I think it was like 7 or 8 homes that are listed. They've been on, many of them have been listed for a while. They're all anywhere from 1 million, 1.2 million. The most expensive I think was 3 million. And I'm like, who's buying that? Like, even though, I mean, they're all beautiful homes, but like none of them are moving.
And when were they built? How old are they?
Oh, some of them are older. I don't know. It's probably a mix. Some are newer, some older. Like there's this like dreamy, like gorgeous older one that's like just stunning. But I mean, they're just not moving. It's like like one of the best neighborhoods in Raleigh, in my opinion.
Well, yeah. Well, that's part of it. In the South, Southeast, Southwest, you had a lot of overbuilding. And this has now taken that market that's above the average, say that $500,000 on up market, and it's compressing. So if you like one of those houses, Julia, just wait.
Oh, I can't afford that. The ones that go the fastest are like in the 600,000 range. Like if a 600,000 pops up, it's gone. But like the million and up, they are kind of sticking around right now.
You just framed it beautifully because that $600,000 house is still relatively affordable. That's why everything above $1 million, which is kind of the top of your market in terms of high price mortgages that you can sell to Fannie Mae and Freddie Mac, it's going to compress. That's why I always tell people here in New York, the conforming limit, which is about 1.1 million now, is kind of your ceiling. Anything above that's going to get compressed. Now, the banks love those loans. If you have good credit, they're going to give you a very good deal on a $1 or $2 or $5 million loan, right? But it's going to be a bank loan, and they're not going to sell it. They're going to keep it.
I also wonder like how much so many folks have so much of their net worth tied up in their home. And I wonder if like you might feel more prosperous because you've seen your home price increase, I don't know, several percentage points over the last couple of years, that I don't know if you feel wealthier because of that and you don't want it to come down. And I don't know. Yeah.
No, the demographics are older now, so people are more focused on saving and limiting expenses. If we were back in the 70s, when the Fed actually allowed deflation, people would wait for home prices to crash, and then they would go out and buy a deal. My parents used to do that all the time in D.C. because it was a very volatile market in the 70s and the 80s. But today, the Fed is so afraid of deflation that they won't force home prices down. Powell actually had mortgage rates up to 8% for a week, exactly 1 week. And then they had to sell off. Now, part of that was just the market demand. You had all these firms out there subsidizing mortgages because they want the servicing. But other than that, it's been a tough market for originating loans. It really has.
Yeah, certainly. Well, Chris, I always love having you on every month. I look forward to it. Before I let you go, any parting thoughts, anything that you'd like to leave this audience to think about or plug? We're going to link to your book. We still want our audience to go out and buy it. So anything you'd like to leave them to think about? The floor is all yours.
Audiobook should be out mid-August.
Nice.
So that's always good. And I'm not reading it. I'm sorry. They wouldn't let me.
They should do an AI voice.
Nah. And all I would say to you is this. I don't want people to think I'm a raging pessimist, but I do know that politics at times can give us outcomes that we don't necessarily want in the long term. So what I would tell you is be careful of the market reaction to the big, beautiful bill and the increase in Treasury borrowing that's going to come with it, because, the marketplace is fragile. I don't think people fully appreciate how many near misses that we have had, many of them with Jerome Powell driving the bus. So, it's going to be a very interesting rest of the year. Let's put it that way. Bank earnings are going to be flat. Credit's going to be creeping up. And I think that's how things are going to look as we go into the end of the year.
Yeah. Well, we are very lucky that we will have you on every single month as we go through the rest of 2025. Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst. It is always, always a pleasure to have you on. I really appreciate you taking the time to share all of your knowledge and your wisdom and helping us all learn and get better. Thank you again, Chris.
Hey, my pleasure, Julia. Have a great day.